Yeah, so Carl, before we get started, I have been so pleased to work with you because you have phenomenal knowledge in this charitable giving area and in the tax area. And I think a near photographic memory, because you have to have a photographic memory in this area or do a lot of research because the rules are so illogical in many ways.
Yes.
And you've got the passion, and you have the passion for it. So
yeah.
tell me what did you do undergraduate? Where'd you go to law school, and how did you end up being such a maven at this?
I mean, first of all, the feeling's mutual. I always appreciate it. I learned a ton over the last hour, so I really appreciated that. You know, philosophy major, was a teacher for a bit, went to law school, Columbia, and made my way into a big firm doing high net worth estate planning. So I have a vague memory of skins and grat, so I didn't know about the scrat. It went up to Adler and Colvin, which is a boutique firm here in San Francisco that serves nonprofits around the country, does some charitable gift planning. And then became a partner there last year, and then around June of last year launched my own firm that's also another boutique firm that focuses on nonprofits, nonprofit law and charitable giving exclusively. So it's probably about 40% public charities, about 40% foundations, probably, and then 10 to 20% kind of working on individuals with some of the stuff we'll talk about today.
Beautiful. Well, congratulations on having your own firm and on being who you are, because there aren't many people with the mental firepower and the ability to be in a relatively small area of tax law that you really have to do a lot of to be knowledgeable in.
So appreciate that, man. Very, very kind of you.
Now, before you get started, and I know this was going to be 30 minutes and it's going to end up, I hope, being at least 45 minutes. We have a lot of viewers who are not tax lawyers and are not CPAs. And like me, they may know what cryptocurrency is, but not be real sure. So can you start 5 minutes for the layman?
Yeah.
Because all of us tax lawyers really need it. Can you just start really, really simplistic? What is it and how is it taxed? So just to make sure we leave no one behind.
Yeah, no, and I think the first few slides I have lined up really are tended to get at that. So maybe we'll start there. Are you seeing the slides okay? Is that all showing?
Yep, they look great. Yeah.
And so I mean, a lot of what's been an interesting part of my practice, sort of being in San Francisco, is just the sheer quantity of questions I get about cryptocurrency. Whether it's people giving them, whether it's people wanting to set up nonprofits revolving around cryptocurrency, all kinds of stuff. And at first, like maybe many people in the audience, you kind of maybe roll my eyes a little bit, or like, what is this? So I really have to learn what these things are. But you have to follow the clients where the money is, and sometimes the money is in these sort of random assets, right? So let's start with sort of cryptocurrency. We have a technical definition of digital currency in which transactions are verified and records maintained by a decentralized system using cryptography rather than a centralized authority. But to break it apart in more practical terms, as we understand it, cryptocurrency is something that lives on the blockchain, which is a bunch of servers all around the world talking to each other and verifying various records and solving math formulas to keep verifying the records. And you could think of it as sort of a global decentralized database. And one of the things on that database is it says there's a database, an entry for a particular coin, and it says you own that coin. So really, when you're buying a cryptocurrency, you're buying the right to get added to that blockchain and have it right. Karl owns this Bitcoin. Of course, I don't own any Bitcoin, but I certainly couldn't afford it at this point. But you get the idea. And we'll talk about NFTs in a second too. But one thing that is useful is to remember that cryptocurrency is a very broad term. We're going to use it pretty broadly today. There was one lawyer I talked to who gave it a really good analogy, because I had sort of said, we'll just assume this sort of nonprofit is willing to accept cryptocurrency. And he said, well, that's like saying this nonprofit is willing to sign an agreement as long as it's a PDF. Like it's a cryptocurrency is a format. It doesn't define what it is. So I've listed some of the common ones, the ones that are treated most like currency. But there's other kinds of things that we call cryptocurrency. We'll talk about DeFi tokens a bit. We'll talk about how there are kinds of cryptocurrency that are targeted to a particular company, really sort of disguised initial public offerings done as initial token offerings, where the thing you're buying is a coin that operates a lot like buying a share of the stock in the company. I've had clients doing energy, sort of sustainability work that launched a coin that was tied to the European electrical grid, and so when you're investing in this token, you're doing something to bolster the electrical grid. I don't understand, but it could be tied to a particular commodity. So it's all kinds of things, really. When I think some of the logos you see are kind of the most common ones that your clients may be running into and have and want to give or want to estate plan with. But they can take all different kinds of forms. So the first lesson is always kind of understand what it is you're getting into. And I guess while we're talking definitions down, maybe it's the other thing I'm going to try to talk about are non-fungible tokens. And this is where you will almost certainly roll your eyes, Deepak, as I have, but we all got to get on board. Non-fungible tokens are really you can think of them as cousins to cryptocurrency. I'm going to lift them all together. These are also on the blockchain with unique identification codes and metadata that distinguish them from each other. I've snapshotted some common NFTs, and these NFTs are somehow worth lots of money. But at the end of the day, what are they? Well, it's an entry in a database that says you own Green Ape 25 on the top left corner. That's yours. You own it. You could sell it to someone else. You could buy it. So these are kind of what we're talking about when we talk about NFTs. And I'll talk why when it comes to charitable giving, NFTs have kind of become particularly popular. Let's keep going. And so you ask sort of for tax purposes what they are. And I think fundamentally the important thing to remember is that the one thing cryptocurrency isn't is currency. It is not currency. You go to the store and you use $100 to buy goods and services, you do not pay any tax. If you go to the store and use appreciated Bitcoin to buy goods and services, you are actually incurring a capital gains tax because that is not currency. Instead, crypto is a capital asset. It's property. And so, and I suppose conversely, if you use the depreciated cryptocurrency, you could also incur a loss. But it's always been sort of strange to me how it's sort of being offered as you can go to the store and buy these things when I don't know that people are recognizing or certainly not reporting all the sort of taxable gain that's being incurred along the way. So that's always seemed a trap for being wary. And the other sort of kind of key point to remember, since we're talking capital assets and we're talking about charitable giving, really important to distinguish between short-term and long-term capital gain. I'm sure everyone's kind of familiar with those concepts, but when we get into the charitable giving rules, which as Alan alluded to, are painfully complicated, short-term and long-term can make a big difference. And so whether you've held this crypto for a year, this NFT for a year, this token for a year, it can significantly impact your tax plan. This chart, we're not going to go through this whole chart. This chart is my unified theory of charitable giving. I want to distill a couple key points. When we're talking about charitable giving, often the public focuses on the charitable contribution deduction. And we're going to talk about the contribution deduction. But it's really important to remember that that's not the only thing that drives charitable giving from a tax perspective. It's just one benefit of one. So obviously, gift tax-free transfer, that's well understood. You give to a charity and also give to a C4, C5, or C6. That is a gift tax-free transfer. So it removes it from your estate. But of course, we have to think about things like 2036 and not going to get pulled back in. I want to know that if that drives a ton of charitable giving, it can in some circumstances, certainly. I think the thing that drives the most charitable giving of all is actually the second box, avoiding taxes on appreciated assets. People don't necessarily give to get a deduction. They give to not have income, have capital gain that they would need a deduction to offset. You don't need a deduction if you don't have income in the first place. So and this is absolutely true of cryptocurrency. What do we know about cryptocurrency? There are lots of people with a lot of assets based on the fact that they bought crypto at a very low number and now have it at a very high number. And they may want to go from having crypto to having a yacht or having a house or having a business. And so they want to sell. And so that when you have something that you want to sell and it's going to incur a lot of gain, that's very commonly what brings people to charitable giving is I'm about to have this realization event. I'm going to give this to a charity that doesn't pay taxes, let it have the realization event. and then I can do all the things I want to do, all the good things I want to do in my charity, or maybe a C4, I could do there. And if I want to get smart about tax planning, I talk to someone like Alan about CRTs and CLTs and how I could sort of not only accomplish a charitable gift, but also sort of either shift assets to the next generation, free of estate tax, or set up a tax favored income stream for the rest of my life. So those are all sort of things on top of you have an appreciated asset. And you can think of all this crypto and NFT stuff as a bunch of appreciated assets. The next thing is tax exemption. That's sort of ongoing income from the asset. Won't bear tax, as that can be obviously helpful. Then we get to the charitable contribution deduction, and as you'll see, I have sort of two sub boxes. One for the easy stuff, cash and publicly traded stock, and one for today we'll focus on cryptocurrency, but also real estate, other business. And you'll see in the sort of bottom part of the chart, and we'll get into this as we go. We know that private operating foundations and public charities get better deduction rules that we'll talk about for those kind of assets, cryptocurrency and other assets. So that public charity distinction, the private operating foundation versus a private foundation distinction, those are very important. And remember that donor advised funds count as gifts to public charity for this purpose. So often some of the charities that have had to think most about these giving of cryptocurrency issues are community foundations and DAF sponsors, because they're getting literally billions of dollars of crypto donated to them, and that raises a lot of these issues. So feel free to look back at this chart and ruminate on it, but I'm going to keep going. I also, thanks, Alan. I also kind of want to make sure we get two concepts. I know we're going to focus on cryptocurrency, but we can't talk about the charitable giving rules unless I kind of break apart two key things to remember. And I think everyone on this call probably more or less understands the difference between basis and fair market value, right? So you buy a thing for $100,000, it goes up to $2 million. Ignoring depreciation deductions for a second, we know that the basis is $100,000 and the value is $2 million. Well, some of the charitable giving rules will give you there are some situations where the deduction is fair market value, and there's some deduction where it's basis. So obviously, the same property being given, if you're eligible for the fair market value rule, you have a $2 million deduction. If you're only eligible for the basis rule, you get a $100,000 deduction. That's a huge difference in value. So that's why the sort of basis fair market value distinction is important for charitable giving always. The other part is the concept of AGI limits. I know everyone understands what AGI is, adjusted gross income. I would say the most unpleasant code section I deal with regularly is 170 and its network of percentage limitations and how they're laid out. We can kind of get into summing up some of them, but the sort of, it might be 20, it might be 30, it might be 50, it might be 60%, depending on the kind of asset and depending on the kind of recipient. But let's just make sure we at least understand what we mean by AGI limit, right? So if I make a gift of $1 million, if I have $1 million of AGI in year one, and I make a gift of $500,000, how much of that am I going to get a deduction for? Well, it depends on the AGI limit. If the AGI limit that applied based on the kind of gift it is and who it was going to was 30%, well, I may have given $500,000, but I only get a $300,000 deduction. So I'm going to have to pay tax on the full other 700, even though in my head I'm saying, well, I gave 200 out of the way. Why am I still paying tax on that income? The other 200K I can roll over for up to 5 years, so I'll eventually get to use it. But I'll have some tax I wasn't expecting in year one if I'm not familiar with the AGI limits. Conversely, if the gift I'm making qualifies for the 60% AGI limit, I could take the full $500,000 deduction in year one. So when you're planning gifts of cryptocurrency or gifts of anything else, you're always thinking about, is this going to qualify for a fair market value deduction or a basis deduction? And two, is that what are my AGI limits going to be? And very often you'll see, we've worked with donors on really major gifts, and often you're sort of layering the gift by the amount of AGI limits you have that year in terms of what charity it can go to. So these things often, there's always this question about what drives charitable giving. Is it philanthropy or is it tax benefits? And of course, it's probably both. But I'll say the precise amount often relates to tax benefits, because often people if you want to make a big gift, you're probably not going to exceed those AGI limits unless you have another plan. Let me see. So those are the key concepts. So let's start rolling into how they apply to cryptocurrency. Let's say I have $1 million worth of Ethereum I bought 2 years ago for 100K. Well, what kind of asset is it? It's not currency, so forget that. It's a capital gain asset. I've had it for 2 years, so this is long-term capital gain property. Let's say I want to give it to a private foundation, a non-operating. I'll pause a second because I'm kind of taking for granted maybe the private foundation, private operating foundation distinction. Your average, private foundation, the Gates Foundation, company foundations, the ones that their function is to have a bunch of money and grant about 5% of that money a year, that's your standard private foundation. I would say most 80%, 90% of private foundations are private non-operating foundations. So those are not only are they subject to the harsh private foundation rules, they are also subject to less friendly deduction and charitable giving rules. So if you don't generally choose to be a private foundation because you want to be, it's usually because you're the only one funding it and all you're doing is making grants. For privately funded entities, if they do enough direct activity, they can be a private operating foundation, which moves them from the left side of this chart to the right side. So I won't belabor that anymore, other than just to say that concept's going to come up a bunch, and something that you may want to think about if you have someone who's founding a foundation. If the more favorable rules are important to them, they may want to be thinking about, can they qualify as an operating foundation? Let's assume you didn't do that and you got just a lousy old private foundation. Well, the private foundation rules, except for cash and publicly traded securities, the only deduction you get is basis. So you're not getting a $1 million deduction for your $1 million of Ethereum, you're getting $100,000. And on top of that, it's only deductible up to 20% of AGI, not 30, not 50, not 60. And so, you would have to have 500K of income in that year to even use your relatively measly $100,000 deduction. So that's sort of the downside of being a private foundation. If you manage to have a public charity, either because you're giving to an existing public charity, you're giving to a donor advised fund, or your client's private foundation has qualified as a private operating foundation, you'd be eligible for a full fair market value deduction. So that's $1 million deduction. Now it is still subject to the AGI limit, but the AGI limit's a little bit higher for these. It's 30% instead of 20%. So if I happen to have $3 million of income, et cetera, I'll be able to, use up that million. Otherwise, I'm going to roll it over for 5 years. So most of that are just sort of general principles, but just remember, donating crypto is a long-term capital gain asset. If your client wants to donate, you kind of need to understand these two charts so you make sure they're giving it to the right kind of charity and they get the tax benefits they want. I'm going to change the facts ever so slightly here, which is changing the word 2 years to 2 months. What does that do? Well, this is capital gain property, so now it's short-term capital gain property. Private foundation still limited to a basis deduction, 100,000. That's no good. It's deductible up to 30% of AGI. Let's not try to understand why it's different. And rolled over for 5 years. Conversely, public charity is still more favorable because they have that 50% AGI. But when it comes, even for public charities, when it comes to short-term capital gain or ordinary income property, the default rule is a basis deduction. So, how long your client has held the crypto for is really important when it comes to charitable giving. Any questions I should take here, Alan, you think? Any questions you have at this point?
No, I think you're doing great. I think you're doing great.
We'll keep rolling, because now I'm going to start getting into some of, these are all sort of broadly applicable. You could use this as sort of to apply to all kinds of charitable giving scenarios, but they come up for crypto specifically. The thing about charitable gifts is when people are giving something other than cash, they're usually giving it at a moment that they think is the highest value and that they expect the charity to sell. And that's all fine, because you know what the charity wants to do? Sell. They don't want to hold on to your crypto. They don't want to hold on to your picture of an ape. They want to just sell it and get the money and put it in their, in their investment pool. Let's say donors giving $1 million of Bitcoin, $100,000 basis to charity. We always need to think about the assignment of income doctrine. The assignment of income doctrine says that if you give something that is practically sold before you give it, you didn't give the asset, you gave the sale proceeds. What does that mean? Well, that means that you pay the gain as though you sold it yourself, and you're treated as giving a donation of cash. And remember what I said, the whole point of so much charitable giving, it's not about the deduction, it's about not paying the gain on the appreciation. So flunking an assignment of income test can really defeat the purpose of charitable giving. I've seen very, very, very large deals go through. Someone, for example, a major merger where this multi-billion-dollar company was being bought out by another multi-billion-dollar company, and the founder had all this stock, and at the time they gave it, the question is, well, is this merger done or is it not done? Because if it's done, you have all the gain on that stock, and you're not going to want to, you may decide how much you're going to give it away, because you're going to have a lot more income this year than you thought you were going to have, and more tax to pay if you give it before the sale is done. And we'll talk about the test is in a second, but let me just the two basic scenarios there. I won't walk you through them. They're more or less what I just said, but I think when you get to the bottom line, notice how different the two scenarios are. In one situation, you not only have avoided all the gain, you have that full deduction for the value. That's the perfect charitable gift is one that completely avoids gain and gives you the full fair market value deduction. In the second scenario, yeah, you got the $1 million of deduction, but you also got 900 in gain, which is going to offset it. Now, okay, you're not going to, maybe, and you can only use, in that scenario, you can only use some of it. Even if you could completely offset it, you've still lost the opportunity to use that deduction to offset other income. So it does make a big difference. And so in terms of what the test is, and for crypto, I think this is actually relatively easy, but if you have clients donating real property and other things, good to remember. The test is whether at the time the donor gave to the foundation, to the charity, could the charity be compelled to sell the asset? And so if everyone knows and expects that the charity is gonna, so that's not an assignment of income problem, it's just an expectation. If the charity started talking to people that might sell it to, that's not an assignment of income problem. If there's a binding binding contract on the real estate you're donating, now it is a problem because the charity could be forced to sell under that contract. This comes up with merger lot, comes up with real estate. Luckily for crypto, it's actually pretty simple. Let's go back to what crypto is. Crypto is a giant decentralized database of who owns it. And so you always know who owns crypto. It's right there in the blockchain. So at the moment of donation, were you the owner or were they the owner? They'll be careful to have any other sort of contracts. If there's sort of a sales contract for the crypto, anything like that. But as long as you're avoiding all that stuff, I think it should be very easy. I do generally recommend, the thing, maybe this is just a lawyer's bias where we always need to see a piece of paper. The thing about crypto is it all happens in an undocumented, unreported way. So it's like very hard for me to be like, well, what day did you give the crypto? Well, it's in the blockchain. I like a nice gift agreement assignment. I hereby give on this day. I'll do the things I need to do to transfer. So, just because, crypto doesn't necessarily require paper in itself doesn't mean you can't paper it up a bit, because I always find that to be helpful on audit. And let's apply the assignment of income rule. We already did it a little bit, but let me give you a common situation that I've actually dealt with a few times on the charity side. What's become very common the last couple of years with this NFT, let's say fad, or maybe you're more optimistic. So, all these NFTs, there's a lot of charities that are saying, well, so-and-so is donating this somehow really valuable NFT and we're going to sell it, and then we're going to use the proceeds for charity, and then the celebrity will pitch it. I'll give another example. When I just sort of searched random celebrity NFT, and I got this one, which was Tony Hawk donating his last ollie as an NFT. So an image of Tony Hawk doing his last ollie. He donated to charity, and the charity would sell it to, for all the proceeds to go. So let's pretend it sells for 1 million, and we'll get into logistics in a minute, but that a broker handles the sale and just transfers the money to charity at the end of the day. And generally speaking, if you're, especially on the charity side, if you're getting involved in crypto, the more you can outsource, the better. Coinbase, Giving Block, all these things are good ways to outsource. The critical tax question is, who's the seller? Because remember, I said that if Tony Hawk sells the NFT and donates it, or gives it to someone else and tells them to sell it and donate it, that's a very different tax result. Now Tony Hawk has $1 million in gain. I can't imagine there's any basis to this NFT that he just created, and he gets an offsetting deduction, but subject to AGI limits. Contrast that with if you give the NFT to to the charity, and the charity is the one that engages the broker to sell the NFT. Now Tony Hawk gets a gift of the NFT. Yeah, it works. It's it may be a lower AGI limit, but there's no gain at all. So whatever deduction he gets, he can use that to offset other things. So I can tell you, I mean, we had a celebrity client that was announcing a big accomplishment of theirs and wanted to launch a whole bunch of NFTs that were going to be auctioned off by their affiliated charity. And it all came down to that contract with the broker. We had to spend a lot of time making sure it was right, that because the broker is an agent, right? They're selling the NFT, the crypto on your behalf. Well, who are they? Who's the principal? Because if the piece of paper on the print, it says the donor's name is the principal and it's authorizing the sale, well, then they're selling it. And that's a big taxable gain followed by a donation. If the charity is the principal on the contract, now we have a gift of an NFT followed by a sale of charity. Charity doesn't pay tax. So all that being said, this is sort of a particular application of the assignment of income rule. It happens in many situations beyond cryptocurrency, but this is the situation where it's actually coming up quite a bit in the cryptocurrency context because people aren't usually thinking about this. They're doing this as a big sales promotion. I could also talk about commercial co-ventures and see those rules and how they might apply to these kind of auctions, but that's a different conversation.
Carl, what is an NFT?
An NFT is a non-fungible token. I'll flip back to that definition for a second because non-fungible tokens are these typically associated with artwork or picture. I gave you some examples of, the best thing you could compare them to, Alan, is sort of like the baseball card market, right? They are things that have value because other people think they have value. And if I think that this NFT is going to go up in value, I might buy it and hold on to it and sell it. So Top Shot is on there. Top Shot was I think still is a NFT creator that just created NBA highlights, and you could buy the NBA highlight you liked, and because you thought this player was really cool, and if it went up, you could sell it later. And this was a whole active market for a while. And like I said, this is the kind of thing that all sounds a bit crazy to us, but there's millions and millions of dollars flowing through the NFT market at all times. So we all kind of have to understand that, like, this is going to come up. Your client is going to have a stupid picture of an ape that he wants to donate, and he tells you it's worth $1 million. And you got to say, okay, well, what do I need to do? I need to make sure it's transferred to the charity before the charity sells it. And how am I going to do that? I'll talk about the non-fungible part of NFT that's maybe worth zeroing in on. So non-fungible, it just refers to the idea that it's entirely unique. It's not like, I don't know, I mean, in the context of Bitcoin or something like that, it might be fungible. It might be all Bitcoins are the same, let's say. I don't really know if that's how Bitcoin people would say it. But with non-fungible token, the idea is that this data entry is the only one of its kind and can't be sort of replaced with any other. So you have a unique database entry that you own the picture of this ape or one of these things or one of the sort of NFTs these services create. And like so tons and tons of this stuff. And I guess I don't know if it's a fad or if we'll still be talking about these 10 years from now, but for now, it's definitely something that comes up a lot. I'll skip over logistics mostly. I think this is more something that tends to focus on the charity side. And if your client has crypto, they probably know this already. When I'm often talking to charities and foundations about, hey, people want to start giving us crypto. What do we need to do to accept it? And I say, look, don't be a hero. Don't try to get your own don't try to have them donate the keys and write down the keys on a piece of paper and put it in a filing cabinet. Just create a wallet on Coinbase or create a same with Giving Block, and these are charity. They'll help you facilitate the crypto gift. Sometimes people who have a lot of crypto have strong feelings about these platforms, and I've had to talk to people setting up their foundations, encouraging them because they really just wanted to hold the keys themselves and not outsource it to a vendor. I don't love that from a fiduciary standpoint on the charity side, but we'll table that for another conversation. Alan, your question, what are NFTs? I think this might be another useful segue. And it's both as an excuse to talk about how the giving rules for NFTs work, which are the same. To be clear, the rules for NFTs are the same as gifts of crypto, same concept, a capital asset. Versus, we can also take a quick reminder of how the deduction rules for artwork and intellectual property work. what is an NFT? Well, I'll tell you what it's not. It's not tangible property. If I buy this NFT below, I can't show up to the Louvre tomorrow and say, yeah, I'll be taking that. That's my Mona Lisa. I'm going to take that home. I don't have any rights to possession. All I have is sort of, the NFT itself. An NFT is not copyright. I could, if I bought this, it will not give me the exclusive rights to produce films in the Mona Lisa cinematic universe. Mona Lisa is in the public domain, but if it were an actual thing that was owned, I couldn't start copywriting it. It's not intellectual property. It's intangible, but it's not intellectual. One kind of amusing anecdote that came up recently was there was this DAO, which is a whole other conversation we can talk about, with decentralized autonomous organization, which is sort of organized through the blockchain. And they raised a bunch of money to buy an original copy of Dune, a big old book copy of Dune. You may have seen this in the news, and I think they spent about $3 million for it. And you'll see about part of their plans. Well, what are you going to do now about Dune? Well, we're going to start writing screenplays. We're going to start publishing, all the things to start doing Dune stuff. And of course, what that misunderstands is just like an NFT is not copyright, the tangible property is not copyright. It's like you may have spent $3 million on that book, but Warner Brothers still owns Dune. So you're not going to be making any screenplays or TV shows or anything of the sort. So just like that, buying an NFT with an image of an artwork, it's not the same as buying the artwork. An NFT is a capital asset. An NFT is a thing that you buy that says you own it. And really, getting back to all of this with crypto, with NFTs, you're buying it because you think that someone else might pay more for it later. And whether that logic is rational, it's the same thing with our baseball cards are inherently valuable. No, they're valuable because someone else might pay for them, or a coin collection. You got to kind of think of it like those sort of assets that it may not entirely make sense why it has value, but if someone else thinks it has value, it's an asset you could donate. To recap kind of what those rules are, and I won't spend as much time as I usually might because I want to get to some other stuff. I'll just leave this chart here. You see that all three of these categories kind of have some weird rules to them. So IP has, when you donate IP, there was a problem where people were donating intellectual property they claimed was valuable but was not. And so the IRS created a rule where, look, if you want a deduction for IP, we're going to tie it to the actual money the charity gets from it. So you say you have a basis in a patent of $100,000. You say it's worth $1 million. You get the appraiser to say it's worth $1 million. But we're just going to say we'll give you a $100,000 deduction. And if the charity makes $1 million, you can have that deduction. But and it's a complicated formula. Tangible work of art, when you donate that, there needs to be a related use. Otherwise, you're going to get a basis deduction. That's important. But NFTs, remember, are just like crypto, which means that if it's long term, it's fair market value to a public charity or private operating foundation, and it's basis if it's a private foundation. We'll get to these rules in a second. AGI limit. I do want to make sure we talk about substantiating the gift. One of the big overlooked things in my mind for all charitable giving, but especially for cryptocurrency, is the substantiation rules. Reminder, cryptocurrency is not currency, and it's not publicly traded stock. So the substantiation rules apply, which means that if you give something that's more than $5,000, including crypto, you need to file a Form 8283. You're going to have the charity countersign that to confirm that you gave. That 8283 is going to attach a qualified appraisal by a qualified appraiser. And you really need to make sure you have both of those things. There are relatively new regs, a few years old, that get into very specific requirements for what a qualified appraisal needs to have. I'll tell you, when people send me appraisals that they claim are qualified appraisals, I can't think of a time where I haven't had at least one comment about what you need to do to make it a qualified appraisal. There's specific language that needs to be in there. And now, in practice, I'm sure many people get by, but remember that what the IRS has this requirement is a tool in its toolbox for when it doesn't like the value you took, it doesn't believe it, but it doesn't want to invest the resources in a billion experts to argue with your billion experts about how much your crypto is worth. It's going to say, look, you don't have an appraisal, or your appraisal left out the magic sentence, so not a qualified appraisal, you lose the whole deduction and we don't have to argue. So people need to give more time to making sure their qualified appraisals are good if they want to manage the audit risk. And also there's note that the charity has a filing obligation if it sells something it got a Form 8283 for within 3 years. That's the way of the IRS finding out that, hey, you told us this was worth $1 million, the charity sold the next year for $10. Are you sure it was worth $1 million? Now, so it's sort of an audit prompt for the IRS. And you might say, and trust me, every client I've told they need to get a qualified appraisal for cryptocurrency has said, but it's actively traded on Coinbase. You can look it up, just like you can look up the price of Google stock or Netflix stock. You can look up the price of Bitcoin or Ethereum or all these things. So why do I need to get an appraisal? So clearly, if it's on Coinbase, surely I don't need one. Doesn't matter. You need to get a qualified appraisal. There's no exception. I would say that appraiser has a very easy job. All they need to do is probably go to Coinbase and say, well, this says it's $10. I could sell it for $10, so it's probably worth $10. But it is, you still need to get that qualified appraisal, or the IRS can knock out your deduction. You might say, what if the crypto is a stable coin? If at this asked, a stable coin, in this one case, it was a coin that no matter what, by formula, is always worth exactly $1. My reaction was, well, why do you need this? Why don't you just have $1? But that's not the kind of question you're supposed to ask. He was like, well, surely if I have $1 million of stable coin, it must be worth $1 million. And the answer is, does not matter. You need to get a qualified appraisal. There's just no way around it for anything other than cash, publicly traded securities, or certain property that has a carve out under the code. I'm gonna mostly skip over recipient issues, but I am gonna say read this at your leisure, because I want to make sure we get to the sort of scenario that Ellen, you teed up, because I think it's a really good way to kind of tie back all these issues. Just remember that if you have a foundation, if you're representing the foundation or the charity, you have a prudent investment issue. Generally speaking, charities don't get to go, what I tell clients is, like, when you have your money, you get to have all the fun with it you want. Go on a roller coaster ride with Bitcoin, it's fun, right? When you have a charity, the AG is not the Attorney General is not a fan of you taking charitable money on roller coaster rides. Generally speaking, not what they want. This is enforced under both a MIFA, which is state rules regarding how nonprofits can invest their assets, and under the jeopardizing investment rules in 4944. Now, that's the standard, and so that's definitely what I tell charities when they want to take their own money and start investing in crypto. This isn't for you. This is maybe perhaps as a percentage of your overall assets. If institutional investors are taking 5 or 10% in sort of the crypto market, then maybe you can do 5 or 10%. But it's not for day trading. There's a little bit of a different answer if it's being donated, or at least we have a little more flexibility, and I often encourage donors to take advantage of this flexibility. For one, 4944, the foundation rule that says you need to prudently invest or we hit you with taxes, doesn't apply to donated assets. So automatically, the fact that you donated Bitcoin says that the charity is not going to have a private foundation rule problem with holding onto that Bitcoin. There's also, under a MIFA, the donor can waive the standards under a MIFA, including the expectation to diversify. This is useful for crypto. It's also used for any number of other closely traded assets where the donor has sort of a unique idea that the charity is going to hold on to this and keep it for a long time. Even if, under nonprofit law, you would say, well, this charity should really diversify. The donor can waive it. I would say there should be limits to this, but this can be very helpful. We had some community foundations out here in California that received billions of dollars of crypto. So their assets were worth, let's say, 20 billion instead of 15 billion. But then next year, they went down to more like 16 billion. And so the AG would look and say, well, it sure seems like you lost $4 billion of the charitable money. What happened? And having things like this, is helpful, at least under the law. I'm going to skip over the securities rule, the UBIT rule for the most part. The bottom line takeaway is just crypto mining is probably UBIT. If you don't know what crypto mining means, if it comes up, remember, it's probably UBIT. Generally speaking, though, just selling crypto is going to be a capital gain. There is some ambiguity in this area. There's a little bit of recent developments and stuff, but I think the safe answer is crypto mining is probably an active trader business. Securities law, really important for nonprofit recipients, not all that important for donors, so I'm going to skip over it. And let's talk about, and I hope the slides look okay, kind of the strategy. Ellen, did you want to intro this, or do you want me to jump in? What would be useful for you?
No, I think you're doing great.
Yeah, so Yeah, so I mean, there's all, like I said, there's all kinds of cryptocurrency, and DeFi tokens are one. I'm not going to pretend to be an expert on exactly what they are, but my understanding is a lot of people who are really into crypto like the idea of sort of engaging with financial instruments in crypto form as opposed to in their traditional form. And so a token could represent sort of a financial instrument. So you might have this financial instrument, which is probably very appreciated in our scenario. You know, that brings up sort of other classic charitable planning techniques like charitable remainder trust and charitable lead trust, also potentially estate planning vehicles to use them, but you have to use them intelligently, because remember that the thing you don't want to do is sell that token or cause a recognition of that token's gain, or you're going to have a lot of income that you're trying to avoid or defer. So often, you know, these tokens usually, and this is true of all kinds of cryptocurrency, usually whatever the thing is donated is converted to commonly traded crypto, like a blockchain, Ethereum, on a platform like Coinbase, and then it could be turned into cash, or it could just be sold for other crypto. This is probably, I've had clients ask, well, wait, why can't I just do a 1031 exchange of my token for another crypto similar asset? IRS has said no. Crypto is not eligible for 1031 exchanges. So if you had that clever idea, congratulations, but the IRS has already ruled it out. So we need to talk about, well, how could we sort of, you know, transfer these cryptocurrencies in a way that doesn't trigger tax and in a way that sort of accomplishes some of our classic charitable giving scenarios. And let me just kind of flip through just to remind myself. Yeah, okay. So the following, you know, so we can do, let's say you own a DeFi token. And one thing that can be useful is to create an LLC. Why? I think you'll see sort of what the function of the LLC is here in a second. But LLCs can be useful, particularly when it comes to giving to charitable remainder trusts. And maybe let's pause and just remind ourselves what charitable remainder trusts are. I could riff on this for a while, but like, let's try to focus on the key things. Why would you create a charitable remainder trust? Well, kind of two things. You want money to eventually go to charity, but you're not in a rush to give it to them. This is very common for couples without kids. Sometimes you'll have the couples without kids. Well, look, I know I'm going to leave everything to charity anyway. But I don't really get much of a, you know, maybe I won't get a tax benefit when I die. You know, I'm not worried about estate taxes. You know, what do I do to get some sort of income tax benefit from the fact that I plan to eventually give to charity? It's kind of what a CRUD is. It gives you a chance to participate in the tax benefits of your deathbed generosity during your lifetime. So when you have a CRUD, the gist is you donate to a CRUD. A certain percentage of the value of the trust will be distributed out to you each year during the term, which is typically your life or your life and the life of your spouse. And it'll make these payments. So you'll get X percent per year. What are the tax benefits there? Well, when you give to the CRUD, let's say I give my $1 million to a charitable remainder trust that's going to pay me and my spouse 5% per year, and then at the death of our survivor, go to favorite charity. A few things happen. One, I get a charitable contribution deduction for the value of the actuarial value of what that charity is expected to get. That actuarial value needs to be at least 10% of the value of what I'm giving. If you're trying to max out the benefits, so I guess it would probably be about 10%. So you're getting a deduction that's small. In my example, let's say the remainder interest was 10% and I'm donating $1 million of crypto, I am going to get a $100,000 deduction. Not bad, could use it for things. The other key benefit that we've talked about a few times is I am going to, let's assume I was otherwise going to sell that token, I would be paying gain on that tax. If I donate it to the CRUD, it doesn't exactly happen that way. It's not completely tax eliminated, but it's certainly tax deferred, and with some degree of tax avoidance as well. And we'll talk about why. So where does the LLC fit into all this? Well, LLCs can be useful for facilitating gifts to a charitable remainder trust. If I have a bunch of things I want to give a charitable remainder trust, or an asset that's a little tricky to transfer, maybe like a DeFi token, if an LLC owns the DeFi token or owns the other assets, all I need to do is transfer the LLC. That's one reason we might use an LLC, and we'll see this as we go. Another reason to use an LLC is sometimes as what's called a blocker LLC or a spigot LLC. These refer to LLCs, and let's back up to the concept of a charitable remainder trust. So one kind of charitable remainder trust is what's called a net income charitable remainder trust. A net income charitable remainder trust pays you the lesser of actual income and 5%. And you might say, well, why would I want to be paid less? Less is bad. Well, you're allowed to have it so that it could be less for a certain number of years and then eventually catch up with a big distribution at the end. That's called a net income makeup credit. And that's the kind of credit I do. So I always talk about credits in two ways. When I'm talking to charities about credits and their planned giving programs, they're offering standard credits. It's always 5%. There's no fancy makeup provisions, none of that stuff. We'll just pay you 5% per year. When I'm talking to donors who really want to maximize the benefits of a credit, I'm talking about net income makeup credits, because what they let me do is keep as much income in the credit as possible for as long for my lifetime until I'm ready to start taking money out. And then when the money comes out, it's coming out on a tax deferred basis. It's been growing tax free all that time, and now the distributions to me are going to be much larger. That's a recap of the benefits of credit, but just to make sense of this. So here we know your donor has a DeFi token. They're thinking about giving to a credit. Step one is let's have the LLC own that DeFi token. Create a wallet in the LLC's name. And I agree that I think again, the nice thing about crypto and DeFi tokens is that what they are all about the record of who owns them. So if the record says the LLC owns it, the LLC owns it. Step two, you transfer ownership of the LLC to the crush. So this is also good because all I need to do is write an assignment. I hereby assign the membership interest in the LLC to the CRET. And by doing that, I have effectively donated the DeFi tokens. Remember, the LLCs are disregarded entities for tax purposes, so that the CRET is going to effectively just receive a gift of this DeFi token. Careful though, when you do qualified appraisals, if I were getting a qualified appraisal for this donation, I'm getting a qualified appraisal of both the DeFi token and I'm getting it for the LLC. And really, what is the value of the LLC? Well, it's just the value of the DeFi token, but I need to make sure my appraisal says it's appraising the LLC, so the IRS doesn't catch me by surprise and say, you got a qualified appraisal for the wrong asset. You gave an LLC. Just be prepared for that. But so we have the donor, we have the LLC, they're transferring the LLC to the CRET. And we know that the way this CRET works is that the CRET's going to hold on to that LLC for lifetime, and it's going to make these payments. Now, the problem is that you would normally have is that, to make payments, you have to make the payments in cash. But because we've moved it to the CRET, to the extent the CRET needs to sell to make those payments, it's happening on a tax deferred basis. So only when you have a CRET and you receive, the CRET itself doesn't pay income tax. Instead, you pay income tax when you get payments from the CRET based on the kind of income the CRET had. It's a whole complicated 4-tier system that I hope you never have to learn thoroughly. But the gist is, as this CRET is going to have a bunch of capital gain over its lifetime, keep growing tax deferred, not pay taxes on it, it's going to pay you your 5% per year. Or if you use a NIM CRET, a net income makeup CRET, a whole bunch of money, a whole bunch of years from now. But that's money you would have been paying tax on potentially the whole time, especially if you were trying to liquidate. Any other nuances there, Alan, that would be helpful?
Will the LLC be a blocker when the LLC sells the Bitcoin? Then under the Principal and Income Act of that state, there's no income to the CRET until the LLC makes a distribution.
Yeah, let's talk about that. That should work, and that's a sort of spigot LLC or blocker LLC concept. So when we zero in on this sort of net income makeup CRET rule, the goal is to not have payout requirements for a long time so that you can have one big payout requirement later. Well, the problem is that if you're selling along the way, you're going to generate some income. If it was just a trust holding the DeFi in token. And so that would result in distributions you probably don't want to make because you want that money staying in there for longer to keep building up. What an LLC can do is under the state's Principal and Income Act, although these LLCs are disregarded for federal tax purposes, they're not disregarded for state purposes. And for calculating the trust income, you look to state law. And state law says that you only have income from an LLC if the LLC makes a distribution to you. That distribution is income, but the LLC itself earning income doesn't automatically result in trust income. So that can be a way to say, okay, let the income build in the LLC. My trust isn't going to have that income for accounting purposes, so it's not going to have to make a distribution, so I can keep building up. There's one thing to be careful about is if you do this, you want the manager of the LLC to be not a subordinate or related party. You want to, under the little bit of guidance we have on this, where the IRS said this works, we know that that was the standard. So you want an independent LLC, manager of the LLC deciding when income is going to the CRUT, but you're certainly hoping that good friendly manager will be distributing the income to the CRUT around the time that the donor wants some money from the CRUT. So then it usually tends to work out just fine. Yeah, so this can be useful. And like this, really, if we just think about when CRUTs are useful, well, CRUTs are useful when you have appreciated assets to spread out the income, the tax, to defer the tax over the course of your life and create a really tax favored income stream. Well, cryptocurrency is also an appreciated asset and is really useful to give both for deduction reasons and for the sort of taking advantage of a CRUT. So crypto is a great asset for giving to charitable remainder trusts. It's a great asset for giving to charities directly, to giving to private foundations. There's some things to think about in here, but overall, I mean, if anything, I think the donation of cryptocurrency is underutilized as a tax planning mechanism. And I think over the last year or two, I've seen charities start to get more comfortable. I think at first they were a little shy about taking it, but now I think charities are starting to see this picture and realize, oh, we could actually make a lot of our donors really happy by taking this and working with them on this, which will be good for both of us. So I think, I mean, at that point, yeah, happy for random questions, happy for anecdotes. I know we went a bit over, so I appreciate those of you who hung on to keep hearing me ramble about crypto.
Yeah, let me tell you some questions here. Do you have any thoughts on a charitable organization creating an NFC for either fundraising or investing?
Yeah, I mean, the way I would think about it would be sort of, to be careful about would be when you create the token, you want to be careful of the charity. So if you're offering, I skipped over the securities law presentation, but I can tell you this, that question would make securities lawyers a bit nervous. If you're creating a token to offer to donors to buy as a way of supporting. What I would say is if you are creating an NFT to sell, and it's not tied to the value of the charity, it's just sort of like a, maybe it's just sort of the logo and something you get to say you own this thing, that kind of thing. Yeah, of course, I think that would work just fine. Remember that, yeah, the charity's selling it. Maybe that's ordinary, maybe it's capital, but we don't care because it's a charity. And so I think you're in great shape from that perspective. And so, yeah, I think if it's as long as it's in that category of just like selling a t-shirt or selling a mug, if it feels like that, that's great. I have seen charities come to me trying to sell tokens that sounded a lot like sort of an offering in a fund or an offering in sort of the value of the charity, and that would make me nervous from a securities perspective. Remember when I talked about securities law, I didn't mention, there are some securities, some tokens that are considered very safe, clearly not securities, so we don't have to worry about securities law. But there's been a giant SEC enforcement action against Ripple for a long time. And that's winding down, but there is risk when you're doing sort of initial token offerings, initial coin offerings, you don't structure them right, that you can make securities regulators unhappy.
And then here's one from Lee. What has been your experience with Coinbase for settlement? Lee's aware of 3 estates that have been waiting for extended periods of time for response or distribution. All requirements have been met, but in one situation, it's over 14 months. That's a little scary.
Yeah, it is scary. Yeah, I haven't run into these issues. I will say the org I work with, again, some of the charities I don't know what Giving Block offers on the estate side, but all the charities I worked with have been very helpful for that. I haven't done, I'm past the point in my life where I do the trust administration, so I haven't run into that. Doesn't surprise me. I think Coinbase is trying to keep up with an explosion of growth and an explosion of regulatory scrutiny. So I think perhaps it's just sort of an adjustment period for them as they ramp up, or perhaps it's a sign that maybe you need to shop around a bit.
Okay, then here's one from Stuart. Where can I find an appraiser who appraises cryptocurrency? Is there a database for them?
You can look around. So I have a few referrals that I use, and feel free to follow up, and I can give them to you. But I do think that anyone that's you've been using for sort of business appraisals, I think people are recognizing this is easy money. This is these crypto wallet, you don't really have to do much. And so I don't think it should be hard to find. I would say use an appraiser you would trust for any other asset and ask what they would do. Are they willing to do it, or do they know someone? Because what matters to me, it's really easy to appraise the crypto, at least for most of these kinds of crypto. What is a little harder is or not harder, but rare, is the appraiser that actually knows what needs to be in the appraisal to satisfy the requirements.
Okay. Now, on the concept of the LLC being a blocker, so the LLC owns the crypto, the LLC sells the crypto, the charitable remainder trust doesn't recognize the income yet. Does it matter what state the LLC is formed in?
That's a good question. I haven't run into I'm in California, and we're comfortable here that it works. I haven't run into a state where that's an issue, but I do know, I think California has changed its principal and income act like 7 times in 7 years. So I think it is something to pay attention to. And so I don't know if you know out of any states that don't work, but I would say every time I do one, I go and look at the principal and income act just to make sure I still feel good about it. Yeah.
Right. Okay, well, that was fantastic, Karl. I thought you did a great job. We've got 156 people who stayed till the bitter end.
Wow,
And,
that's really appreciated.
Yeah, my only question is, when can you come back and do and show that one slide that you started with, the Karl Mill comprehensive view of charitable giving? When can you come back and present that for us? Any Saturday at noon.
Yeah, we're doing a 2-part. I know we're doing a 2-part session on the CPA Academy during I don't know if you have the dates in front of you, Alan. I could probably find them. I think one is February 15th.
Yeah, I'll have Kelsey send everybody.
Yeah, that'd be great to send that around.
But if you could come back on because that's for CPAs, but if you can come back and give a layman's talk.
Yeah, would love to. We'll get something set up. I would love to break down that chart. It'll give me an excuse to keep honing my unified theory and making more flow charts.
Yeah. So for all the attendees, you've got Karl's email address there, karl@mill.law. And I'm Gassman@gassmanpa.com. Send me the easy questions, send Karl the hard ones, and we'll be more than glad to answer. We learn a lot from questions. And Karl, thanks again. Thanks to everybody. I hope everyone has a fantastic rest of the day.
Thanks.